All right, let's dive in. Today, we're doing a deep technical investigation into the Nifty 50. You know, after that incredible run-up, it looks like the index has hit a pretty serious wall. So we're going to break down all the signals and see what might be just around the corner.
So you've probably seen it. After climbing and climbing, the market just slammed on the brakes. Hard. And really, it leaves all of us with one huge question, doesn't it? Is this incredible bull run for the Nifty 50 finally done?
Okay, let's jump right into the charts because, wow, you have to see this. What you're looking at is the weekly price action, and that single massive red candle, well, that's the whole reason we're having this conversation. In one fell swoop, it just erased weeks of gains. Now, that's not just a dip, that's a serious red flag that a major shift could be happening right now.
All right, so to really understand what's going on here, we need some kind of framework, a way to make sense of the chaos. And for this investigation, our number one clue, it comes from a really powerful tool called the Elliott wave.
Now, if you're not familiar with it, don't worry. The basic idea of Elliott wave theory is that the market isn't just random noise. It actually moves in these predictable patterns, these waves, that are all driven by human psychology, fear and greed. It's kind of like breathing, right? The market breathes in on the way up, and then it has to breathe out on the way down before the next big move.
So when we apply this theory to the Nifty's long-term chart, we get a huge piece of the puzzle. The analysis is telling us that the recent peak, that wasn't just some random high point. No, it looks like it was the completion of a big corrective pattern, what we call a wave B top. So in the predictable rhythm of Elliott wave theory, if you've just finished a wave B, what do you think comes next? You guessed it, a powerful downward wave C. And let me tell you, wave C is usually the one you have to watch out for. It's often the sharpest, most decisive leg of the whole correction, and its job is basically to undo a big chunk of the previous rally. But look, one theory, no matter how good it sounds, is never enough to build a case on. It's like a detective story, right? You need supporting evidence. So let's dig into the other clues that seem to be pointing in the exact same direction.
Okay, clue number one comes from Fibonacci analysis. Now, this is all about finding key support and resistance levels, and that brutal sell-off we saw, it wasn't random at all. It just sliced right through a critical Fibonacci support level at 23,530.80.
And I really want to stress this. This wasn't just a little dip below a line. This was a structural failure. When a key level that's been holding the market up just breaks like that, it's a huge signal. It tells you the power has shifted from the buyers to the sellers, and the whole trend might be about to flip.
All right, clue number two comes from something called Gann Cycle analysis, which is all about finding turning points based on time. Now look at this date right here, February 20th. Gann analysis actually pointed to this exact date as a high probability turning point. And what happened? Like clockwork, the Nifty peaked and the big reversal kicked off. So let's recap. We've got Elliott waves, we've got Fibonacci levels, and we've got Gann cycles. Let's put all the pieces together and see what the full picture looks like.
This table really lays it all out, doesn't it? Our Elliott wave count says we're in a downward wave C. The Fibonacci analysis shows we've broken critical support. That weekly bar we saw, that's a huge bearish reversal pattern. And the Gann date, it nailed the top perfectly. You see, when you have all these different independent tools all screaming the same message, well, that's something you really have to pay attention to.
Okay, so we've laid out all the evidence. Where does this all lead? What's the final verdict from this technical deep dive?
The analysis points to a target of 22,000.
And looking back at the chart, you can see that 22,000 isn't just some number pulled out of thin air. It represents a really logical target for where this whole corrective wave C is expected to finish up. It would bring the market right back down to a major support zone from before.
So, we'll leave it with this thought. With all these technical signals lining up, the wave count, the broken support, that reversal candle, it seems like the question isn't just if the Nifty is going to test that 22,000 level. The real question, the much more interesting one, is what happens next?